Hello traders, it's Wednesday, March the 5th. This is John Kicklighter, Chief Strategist for DailyFX.com, here to give you your FX market wrap-up for the past 24 hours of trading, as well as an outlook for what we expect in the coming 24 hours ahead of us, and of course, going beyond. Event risk continues to run pretty heavy, and the news-based event risk that cannot be scheduled certainly continues to drive the underlying risk current. A very volatile theme, but not one with a lot of staying power as we continue to see develop. Now, of course, in the past 24 hours, I think the biggest story on the day was the SP500. Not only was this benchmark for risk trends, which generally rose across the boards, soaring to record highs, it was a follow-up to one of the biggest drops we've seen on risk trends in quite a long time, a number of weeks, almost a month. So this is a back and forth in volatility, a back and forth in risk trends that is definitely giving us a lot of turnover, a lot of churn, but not necessarily the kind of trends that we want to see. We want to look for consistency, at least in some medium-term time frame setups, and that's not what's coming through the line. Now, we have to remember that. We have to remember that these are more volatile conditions than they are trend-worthy conditions because they set the tone for how we should look at setups. All right? A lot of people would look at the SP 500 testing new record highs and suggest that this is a strong bull market. Well, as we've seen numerous times throughout the past weeks, we've tapped and hit new record highs. We've closed at record highs, and yet the momentum just seems to fall apart every time we get there. All right? This is essentially a market that is more focused on short-term opportunities, taking pullbacks and driving them forward with covering of those positions because they don't generate traction. All right? These are essentially what we call vol sellers, or those that are speculatively buying on short-term dips. All right, vol sellers is perhaps something that you have come across, and it's certainly very important right now. That's why I made it today's strategy video. You can check that out a little bit more in detail, but you can essentially acquire the knowledge or understand what it is in general when you look at the VIX index here. All right. This is the volatility index for the equity markets, specifically the US-based equity markets, but the same kind of conditions are happening across all asset classes, including our FX trades. We saw a big jump on Monday's volatility index related to the uncertainties in the Ukraine with the standoff between Russia and the Western world, where we see political and economic sanctions being threatened against each other, which is a disruption of risk trends. All right? It's one of those situations where we blur the edges of how it will impact the market. I can plot out a scenario pretty clearly about how a rate hike would impact the market, how a bond default would impact the market. These are all relatively known events. But something as intangible as this, something as fluid as this, is very difficult to get a grasp on. We can't really prepare, we can't really hedge very well for it. So the impact tends to be much more severe. We had that big jump and that uncertainty, but what did we see immediately afterwards? All right? After that jump in volatility, the pullback in risk trends, we had a drop in volatility and subsequently a jump in risk trends. A good way of looking at this is right here. This puts the S&P 500, our risk measure, versus the VIX indicator, VIX index, which is a volatility measure or a fear indicator. This is flipped upside down. We know this. We've been looking at this chart pretty regularly. And you can see every time that volatility jumps sharply, and it lines up nicely with a pullback in these risk gauges. All right? The markets are taking advantage and selling that volatility, in essence. Right? Now, selling the volatility is a very different thing than just buying dips. Buying dips, you can say this pullback here, I bought this and I held it for the long haul. That has a longer-term bearing on it. What I'm talking about here is just selling of this short-term inflation of risk premium. All right? You're fading a crisis flare-up in risk themes. Right? And that doesn't last very long because, as you can see, we drop back to these normal volatility levels, or these exceptionally low volatility levels, actually, very, very, very quickly. All right? So this is more of a very short-term response to risk trends. That's why we've seen these jumps in volatility quickly fade, and as the volatility fades, the markets move quickly to the upside. They don't go very far, but they move very quickly. Now, in this response to short-term flare-ups, we're also seeing that there is relatively little in the way of volume to support these bullish moves. Now, of course, we have this past session a new record high, a very exceptional move to the run to the upside, SP 500. This time around, we even saw the yen crosses taking part. All right, you had the dollar yen, you had the euro yen, you had the pound yen. Yen crosses rose. Global equities rose, not just the S&P 500, not just the Dow, not just the Russell, which was a big headline for the day. Asia equities, huge Nikkei 225 day. European equities, huge rebound. All right, this was a risk rebound in general. However, consistently across the board, we're seeing that they are founded on exceptionally low volume. All right, this is the volume measure right here for the S&P 500, and as you can see, relatively restrained. You're not even hitting the kind of turnover that you had seen back in late January. All right, so this is still a very restrained rebound in risk trends. Now, while I think that a drop in volume is actually not necessarily a bad thing, at least the initial drive or a consistency of momentum would say that you have an elevated period of volume. You don't have that right now, all right? And we haven't had that actually for a long time in these markets. So we're left with a market that is really prone to just fast switchbacks, right? This is actually a very good representation of what kind of market conditions we have. This VIX index, this volatility index, right? Flipped upside down, so normally it would look like this. And I'm going to do this so you can get a better sense of it. But as you can see, we are kind of just doing switchbacks. And the retrenchment of that low volatility state after it bounces is where you're getting most of your lift. All right? So the markets are just waiting for opportunities to see negative headlines, some kind of crisis pricing, and then subsequently they retreat, the volatility retreats, and they ramp their gains on that kind of movement. All right, this is also why you're seeing a lot of stories related to short sales being the best performing stocks. All right, now of course we can't really short in the FX market here, but in equities, there is actually a lot of short interest out in these markets, and they're trying to short these shares, expecting that the markets are overdone and that they will inevitably start to come back. Well, as we know, the markets can remain irrational longer than we can remain solvent. Those shorts, as they tip higher and higher, all right, or as they stay buoyant, those short interests are just covered. All right, and when you cover those short interests, what happens? You give the market a boost. All right, you essentially have to buy back those shares. That bid order goes through, and it lifts those equities. Right? That's why the most heavily shorted shares are the best performers. All right? Just like selling vol, they're selling shorts. They're covering those risky negative exposures. So this is the same kind of circumstances you're seeing across the board. The question is, how far can this go? How consistent can this theme last? And realistically, will we move up this risk severity curve? Will this essentially turn from a correction where traders try to take advantage of the short-term correction into a more consistent and market-moving momentous theme? We're waiting for that theme. We're waiting for that driver. But we need to move up that scale if we expect to break the S&P 500's 5-year bull trend. Right? If we expect to see the US dollar seriously make a bid for this multi-year trend line resistance, right? If it wants to get back there, we need to see something that is far more convincing on this front. Right? In the meantime, we will keep our eyes on those short-term volatility plays. All right? They offer opportunity just as much as anything else. We just have to keep the time frame correct in our mind. Not only can you see this play out potentially in some volatility for the US dollar, though this is going to be relatively small ranges. All right? You can see it in equity CFDs or equity futures or equity spot or ETFs. All right, those will definitely play out with volatility. But you can also see it in the yen crosses. Now, the yen crosses are more interesting in my book because they have more consistent technical levels. All right. Now, of course, when you're exposed to volatility, back and forths in headlines like this, if you're very near approximate technical level, it's actually easy to break. All right, so you're not going to get a break with follow through. You'll get false breakouts. But you can definitely see those short-term swings as long as they align to the fundamentals. The market conditions and the technicals will help play through those short-term swings. All right. The dollar yen, as you can see here, does have a lot of back and forth. Doesn't have as clear and clean as technical levels as I'd like, but that's more of the appeal of the pound yen, which you can see here has a very nice range starting here in the middle of February. All right, it's been going back and forth. The range is actually turning into a wedge, and this is inevitably going to break. The question is what breaks it, because what breaks it will provide follow-through or won't, depending on what it is. But you can see here that the first level of break is going to be 171 down to about 168.75. But then if we make a move to the downside, a much bigger wedge exists, and that butts us up against a very important rising trend line that has lasted for quite a long time. All right, I would be very dubious of the move to the upside, though, because the momentum is going to be very dependent upon risk trends. All right, if it doesn't fall onto the shoulders of risk trends, it's going to have to be fed by the Bank of Japan or more stimulus expectations. And as we have been tracking for some time now, those stimulus expectations have certainly started to fade. All right, this is the dollar yen now, going into the next, or the April BOJ policy decision, which is expected to be the time frame for that upgrade to open-ended QE. And this light purple line is the move that it made into the first open-ended QE program. All right, so you can see that we are well off that pace. So if you're looking for continuation, you have to be very, very careful upon those expectations and those assumptions. You need a fundamental drive to give that follow-through. And this is especially true in these general market conditions. All right? Note that I'm talking about technicals, fundamentals, and market conditions. These are important to incorporate all three. Have them work in your favor, because when one works against the other two, it makes for complicated trades, and it certainly does hijack and sabotage those setups that we have. The euro yen, similar situation, down here to 138.75 up to, I would say, 141. Very tight range, same circumstances, strong trend is backing it. We can take a look over at some of the higher yielding yen crosses. They're actually at the extremes of their particular ranges. Kiwi yen in particular is the most interesting. Just stalling and biding its time up here at 85.85 down to 85.75. This is a nice range top. This is certainly a pair that has held these levels pretty well. It only has about 125 pips, maybe 150 pips at most in this range, so you have to be relatively careful and set your expectations reasonably. A lot of people go to a yen cross and they expect to make 250 pips. Well, not in these types of market conditions. Not if you're expecting ranges and you have the right catalysts for ranges. Aussie yen's not as clean, but you can see the technical levels are pretty clear here. CAD yen, very much the same way. All right. But the yen crosses aren't the only pairs that I'm going to be looking at. There are a lot of interesting developments we are following related to economic event risk in Australia, for example. The RBA this past session did decide to leave their policy unchanged, as we expect. They warned that they keep rates exceptionally low for a longer period of time, as expected, but they also revived the concerns or the statement that the Australian dollar is high on historical level or on a historical basis. While this is not necessarily very inflammatory commentary, it does suggest that they are making some of their decisions related to the Australian dollar. This led to a little bit of volatility for the Aussie USD. Didn't really lead to any significant momentum. It helped ramp up the Aussie yen with that decline, then subsequently rebound as we saw the yen crosses perform. Aussie CAD has worked its way back up to the floor of this rising wedge formation. As you can see, the market didn't really take too much away from the RBA's statement because it didn't really change all that much. And I'm also keeping an eye on the Aussie Kiwi. As you can see, it's starting to round out again. We'll see if it makes another bit higher. If it does, this might be my entry right here as we break above 107.50. Now, we are also going to have to keep the majors in mind, especially as we move into the second half of the week. Things are going to get much more interesting with the docket. We have the pound dollar, or the cable. We have the BOE rate decision coming up, although we don't expect anything from them on Thursday. Much more interesting is going to be the euro. All right. Now, We'll cover this more in depth tomorrow as a lead up into the ECB rate decision, but this is certainly going to be interesting, as there is good probability, or at least speculation, that the ECB, the central bank, is going to enact some new stimulus program, whether it be an effort to stop sterilizing the bond purchases that they have to increase excess liquidity, whether they introduce a new rate hike, whether it be stimulus or no change. There are some good dispersion of expectations here, and that means there's going to be some surprises. I'm very interested in this Euro USD. Very big technical range, wedge, all right? And we know that the ATR is saying it wants to break out, and we just need that catalyst. This is a very stalwart, stable pair. It needs something to disrupt it. Will we have that in the ECB rate decision? It's a very tall order, but it's a possibility. Cover more of that in tomorrow's video. In the meantime, keep your eyes on these flipping risk trends. They are all over the place, and they will give you a lot of those short-term setups. Good luck trading out there, guys, and we'll wrap you up on the markets once again tomorrow.